Let me share my screen.
Assalamualaikum warahmatullahi wabarakatuh.
Alaikum assalam.
Good afternoon, everyone. This is General Lecture event with our speaker, Mrs. Kidil Al-Mujtadi from Department of Business Administration, Al-Aqsa University. If everyone ready to start, I will open the session. Before we start, I would like to remind you to open your camera and mute your audio. Also, I would like to inform you to rename your name to your full name since it will be used in the certificate. The Honorable Mrs. Kidir Al-Mujtadi as the speaker for today's event. Mrs. Fitri Wahyuni, SAMSC, as the Head of International Program of Accounting, and the participant who attended today's general lecture. Alhamdulillahirabbil alamin. Wassalatu wassalamu ala asyrafil anbiya wal mursalin wa ala alihi wa sahbihi ajmain, amma ba'du. Praise to the presence of God Almighty, who still gives his guidance and mercy to all of us, so we can attend this today's general lecture in a good health. Blessings and greetings. Let us devote to our Lord and Prophet Muhammad, who had brought us from the time of Jahiliyah, leading into this era that is full of inayah. The topic of today's general lecture is Valuation of Inventories, which will be delivered by our special speaker, Mrs. Kidir Al-Mujtadi. Let me introduce myself. My name is Aisy Regina Preita as the Master of Ceremony. Here I would like to show you the agendas we have arranged today. The first agenda is opening. The second agenda is general lecture session. The third agenda is question and answer session. The next agenda is photo session. And the last agenda is closing. Let us start the first agenda by reciting Basmalah together. Bismillahirrahmanirrahim. The next agenda is general lecture session in subject of financial accounting with the topic Valuation of Inventories and will be delivered by Mrs. Jidir Al-Mujtadi. To Mrs. Jidir Al-Mujtadi, time is yours.
Okay. First of all, I would like to thank Muhammadiyah University for giving me this opportunity of participating in the International Program of Accounting. Really, it's my pleasure and my honor to be the speaker for this lecture today. And also, I would like to thank all members in this collaborative program for their assistance and support. I would like to welcome all the students here, and I would like that this lecture will benefit for each of you, inshallah. But first of all, I would like to have share screen, but it's not, I don't have the ability. So can you please make it, can I share it, please?
Yes,
I'm not.
We'll try.
Okay, thank you.
Okay, Miss, you can try it.
Okay. Does it appear for you?
Yes, Miss.
Okay. Bismillahirrahmanirrahim. Today our lecture is about the valuation of inventories, a cost basis approach. As we know that inventories is very important for any business activity because it has its effect on balance sheet as it appears under current asset category. Also, it's vital in determining the result of operation in income statement. And each company must know that it must hold the appropriate amount of inventory, because having many excessive inventory will lead to many burdens and many expenses like carrying expenses, and having little amount of inventory will lead to unsatisfying the demand, so will lead to dissatisfied customers. So today we are going to understand what is valuation of inventory. Now, the learning objectives. After studying this chapter, we will identify the major classifications of inventory, and we will be able to distinguish between perpetual and periodic inventory systems, and to identify the effect of inventory errors on financial statements. We will understand which items and which cost will be included in inventory cost. And finally, and the most important, is to describe and compare the methods used to value inventories. And we will have practical examples about these methods, inshallah. Now, this is our map for this topic. First of all, we will define inventories and understand how to classify inventories. Then we will look at the cost flow of inventory and understand why control on inventory is so important for companies. Then we will talk about the main and the basic inventory issues, which are 3 topics: the physical goods, and we will talk about the goods in transit, consigned goods, and some special agreements, and its effect on financial statements, because as we will learn after a while that any error in physical goods will lead to inventory errors in costing, and will have effects on financial statements like balance sheet and income statement. The second topic of inventory issues will be the cost included in inventory. So we will differentiate between product costs and period costs. And finally, we will have a look about the cost flow assumptions, the methods of valuation, which are specific identification, average cost, FIFO, and also LIFO method, and make a summary analysis about these methods. So this is the map of our lecture today. Now let's begin. We will first define inventories and understand the classification of inventory. Inventories are items that held for sale or goods to be used in the production of goods to be sold. Now, as we know that the businesses that deal with inventories are either merchandiser or a manufacturer. So those merchandiser companies, they deal with the goods that are in form ready for sale. So inventories for them will be items held for sale. But the manufacturers, those are companies that deal with manufacturing goods. So the inventories for them will be both items held for sale and all goods that are in the production phases. Okay, so here we have a merchandising company, Carrefour, for example. Look at the balance sheet under the current assets category. We have one classification of inventory because this is a merchandiser company. So it has its inventory is the goods that are in the form of goods available for sale. For example, if we have a grocery store, so the grocery store has canned products, has dairy products, meats. So all of these items will be categorized in one category, which will be called inventory. But here in the second example, we have a manufacturing company. By looking at balance sheet under current assets, look, we have under inventories, we have 3 categories, 3 classifications or 3 accounts. We have raw material, work in process, finished goods. Because as we just said that manufacturing company has or deals with manufacturing goods. So first of all, it will purchase raw material, which are the components that in hand and not yet entered the production process. And work in process is the items that entered in the production phases, but not yet finished. Finished goods are the goods that finished in production and they are available for sale. So let's have an example. For example, a car manufacturer, it will have raw material consist of steel and aluminum. Work in a process, it will be the half assembled cars, and the finished goods will be the cars available for sale. So here we classify inventory. Under a merchandiser company, we have one account, which is inventory. But on the other hand, for a manufacturer, we have 3 accounts for inventory: raw materials, work in process, and finished goods. Now, inventory cost flow. For a merchandising company, the cost of goods purchased will be transferred to the cost of goods sold when these goods are sold. But look at the manufacturing company flow, flow of cost. Here we have raw materials and labor and overhead. All of these items or all of these costs will be transferred and entered in work in a process. And then work in a process and then the work in a process costs will be entered in the cost of goods manufactured. And those costs of goods manufactured, when they are will be entered in finished goods. And the finished goods, when are sold, they will be entered in the cost of goods sold. So this is the flow of cost in a merchandiser company and here in a manufacturing company. Okay. Just a second, please. بدي أرجع أقيم أشيل القلم مش قابل. Just a second, please. Okay. Sorry. Now, here we have the cost of goods available for sale. It's a very important and vital concept. Here, according to our illustration, the cost of goods available for sale consists of 2 things. It consists of beginning inventory plus cost of goods purchased. What does we mean by this? Now, for example, if we are in year 2020, so and I want to determine the cost of goods available for sale, I will take the inventory at January 1st and will add the whole purchases that I purchased during the year. So the summation of them will give me the cost of goods available for sale. So cost of goods available for sale is very important because we will use it in practical examples, as we will see later. Now, so beginning inventory plus cost of goods purchased will equal cost of goods available for sale. Now, cost of goods available for sale, it will be either will be sold, and the goods that will be sold will be or will go to cost of goods sold, and the other goods that not sold and remains on hand will be transferred to cost of ending inventory. So cost of goods available for sale will be divided into two categories: the goods that we sell will result in cost of goods sold, and the goods that we didn't sell and they are remaining on hand, so they will give us ending inventory. Now, we have two systems for accounting for inventory: perpetual system and periodic system, and we will understand how to differentiate and what are the major differences between the two systems. Here we have a comparison between perpetual and periodic systems, and we want to differentiate between them. Here I will learn you the most
Wait a minute, there is a problem in the connection.
Sorry, there was a problem with the network. I'm so sorry.
Yes, it's okay, Miss.
Okay. Now, here we are in the differences between perpetual and periodic system. So first of all, for purchases, the transactions, as we said, that the whole purchases transactions are recorded to inventory account. So for example, if the company purchased goods from a supplier, it will be debited to inventory. If the company paid freight in, it will be also debited to inventory. And if the company returned some goods to the supplier, it will be credited to inventory. And if it has a cash discount from the supplier, also it will be credited to inventory. So the whole transactions related to the purchases are recorded at inventory account. But on the other hand, for periodic inventory system, we don't use inventory account in our entries. We use different accounts. We will open a purchases account, a purchases return account, also a purchase discount account, freight in account. Okay, so this is the first difference between the two systems. At purchasing transactions, we use here just inventory account, but here we will use the different accounts. Now, let's go to the second difference. For sales transactions, both systems have the same accounts. What do we mean by that? This means that we will use sales revenue account for both systems. We will use freight out account, we will use sales return and sales discount. But the difference is here. It's for the entry of a cost of goods sold. This is the difference between them. Here in perpetual system, we will make an entry for cost of goods sold, and because it's a cost or an expense, so it has a debit nature and it will be debited. And because we sell inventory, so inventory decreased and it will be become in the entry credited. But look at periodic system. At periodic system, there is no entry for cost of goods sold. So the second difference is for sales transactions, we use the same accounts, but the difference is for the entry of cost of goods sold. Here we have to make an entry in perpetual, but on periodic we will not make any entry for cost of goods sold. It's not involved. Now, about the detailed records of inventory, we have for perpetual system, we have detailed records for inventory purchases and sales. So we can perpetually, what do we mean by perpetually? It means continuously. So we can continuously determine the inventory on hand. And cost of goods sold also can be determined any time the sale occurs. But here at periodic system, we can't determine the cost of ending inventory nor the cost of goods sold until the end of the period. So it's called periodical. Okay, so here in perpetual we can determine the costs continuously or perpetually, so it's called perpetual inventory system. But here in periodic we can determine it until the end of the period, so it's called periodic inventory system. And here at periodic system we need to make something called physical count for the inventory. So we have to determine the quantities of inventory, then to determine the cost of those quantities, and at the end we can determine cost of goods sold. And this will be taken with our practical example, inshallah, after a while. Now let's have this example for inventory cost flow. We have this company that had the following transactions during the current year. He gives us the beginning inventory, the purchases, the sales, and ending inventory, the units and the cost price for each one. Now, the instruction is to record these transactions using the two systems, the perpetual and the periodic one. Now, for beginning inventory, beginning inventory is the inventory account that shows the inventory on hand at the beginning of the period. So we don't need to make any entry for beginning inventory. Now look at the purchases. We have purchased 900 units at $6. So as we just said that for perpetual system, the whole transactions related to purchases are recorded to inventory. So we debit the inventory account and we credit the accounts payable because we purchase on account. But here for periodic system, we use different accounts and we don't use inventory account in our entries. So we debited purchases. Purchases have a debit nature because it's like an expense. We purchase goods, so we have to record it in the debit side. So this is the difference in purchasing. Here we record at inventory, but on periodic we record at purchases. Now, what about the sale of 600 units at $12? Now, look at the first entry, account receivables to sales revenue. Here we have the same entry at perpetual system and at periodic system, because we said that in both systems we will use sales revenue, sales return, freight out, etc. But the difference is in recording the entry of cost of goods sold. So look here, we have a cost of goods sold entry in perpetual system, but we don't have this entry in periodic system. So here in perpetual system, we said that those 600 units, the $12 is the selling price. So it consists the sales revenue. But here, cost of goods sold at $6, the $6 is the cost unit. We get it from the previous transactions. Now we will record, as we said, the costs has a debit nature, so it will be debited to cost of goods sold, and inventory will be credited because the amount of inventory decreased because we sold it, so it will be credited. And as we just said, that there is no entry for cost of goods sold for periodic system. Now, at the end of the period, we have 400 units. Now, we have a beginning inventory here, 100 units. And we purchase 900 units. So the whole units are available are 1,000 units. And we sell of them 600 units. So the remaining balance is 400 units. Now, those 400 units at a cost of $6, do we need to make an entry for them? Of course, for For perpetual system, we don't need to make this to make any entry, because we have inventory account, and we can make the T account of inventory. Okay. Okay, and at the debit balance, we have beginning inventory 100 multiply 6, which is $600. And we make a purchase and record this purchase on debiting inventory 5,400. Then we sold inventory at $6. The selling price go to sales revenue. I don't want it, but here the inventory here that's credited in the entry, which is 3,600, will be credited. So the balance of ending inventory will be 600 plus $5,100 minus $5,600, and we will reach to the $2,400 by balancing the inventory account. So we don't need any entry. But look here at periodic system. Did we use inventory account in our entries? We don't use it. We use purchases account, and here we didn't make any entry to reduce the inventory. So we have, and not just we have, that we must make or record an entry at the end of the period for those 400 units. So to understand this this entry at periodic system, okay, to understand it, just a minute to delete those. Okay, now we have the beginning inventory, okay? Beginning inventory, which is $600. And we make purchases during the year, which was 5,000 purchases. Okay, I will write the abbreviation in order of time. Okay. The purchases will be 5,400. This purchases that we make here, and the ending inventory, of course, by periodic system, as we will see and learn after just a minute, we will compute it using different methods. So assume that we calculate ending inventory, and it was 2,400. So this is the equation to get the cost of goods sold. Now, cost of goods sold will be 600 plus 5,400 minus 2,400, and it will be 3,600. Of course, this equation, we will learn it after a while in more details and will be more clear, inshallah. Now, why I do sorry for the network interruption. I'm so sorry for that. Now, everything I wrote was deleted. Never mind. Okay, we'll be right back. Now, so we want to recognize inventory account and cost of goods sold. And as we said, that inventory account is a current asset account, so it has a debit balance and it must be recorded on the debit side. Cost of goods sold also, it's a cost, an expense, and it also has a debit balance, and I want to recognize it, so it will be recorded also on the debit side. But for purchases and for beginning inventory, they are temporary accounts and we want to get rid of them. So we will put them on the credit side. So this is the adjusting entry that we must record it at the end of the period for the periodic system. But again, for the perpetual system, we don't need it anymore because they are existed in the books. Okay, hope that the differences between perpetual and periodic are clear and everything goes smoothly. Okay, so we talked about the differences in purchases and about differences in sales. And last thing about the adjusting entry at the end of the period. Here we don't have to make anything, but at periodic we have this entry. Okay, now why inventory control is so important for companies? All companies, whether they use periodic system or use perpetual system, they must have a physical count. They need periodic verification of inventory records by actual count or weight or measurement with the counts compared with the detailed inventory records. So any company must make a count or a physical count for its inventory and compare this count with the inventory records it has, in order to be ensured and to verify the inventory that is recorded in our books. And this physical count must be taken or undertaken in or at the end of the fiscal year to properly report inventory quantities in annual accounting reports. Okay, so the physical count is very important to make control over inventory. And even I use perpetual system, and at perpetual system we have, as we said just before, that we have a detailed records for inventory, but we need the physical count to control the inventory and to be sure that there is no theft for inventory and everything is recorded properly. Here now we are in the second section of our lecture, and here is a very important issues in inventory valuation. And we said that we have three issues in inventories. First one is the physical goods, what will be included in our count and what must be excluded in our count. Second, what are the costs that will be included in inventory? And third, we will look at or understand the methods of valuation. So these are the three basic issues in valuation. Now, first of all, the physical goods. As we know that the company must count the goods that it has on hand, but we have some situations and some consideration, we must take them into consideration. For example, we have goods on a transit. We have something which called goods in transit. We have consigned goods. We have a special sales agreement. What about them? How these situations have some consideration about the ownership of the goods. Now, for example, goods in transit. Goods in transit means that the goods that are with the hand of the general carrier. We have two conditions. We have FOB shipping. Okay. Sorry, because it's a drawing, so maybe it's not so clear. Okay, FOB shipping, and we have shipping, and we have destination. Okay. Okay. These are the two terms, shipping and destination. FOB destination. Now, if the sales term is FOB shipping, so at FOB shipping, the legal ownership passes to the buyer at when the general carrier receives the inventory. So when the general carrier receives the inventory, directly the ownership will be with the buyer. So I have to include them in my count. On the other hand, FOB destination, the legal ownership for the goods are still with the seller until the goods are received at the buyer place. Now, consigned goods, it's an arrangement between the consigner and the consignee that we lift the goods for the third party to sell it. Now, the consigner, he has the ownership of these goods, even if the consignee is the holder of them. But the ownership and which party must count the consigned goods under his count is the consigner. And this is a very important note. For special sales agreements, we have the buyback, we have agreement of buyback, and sale by installment. So at for example, at buyback agreements, the seller has the economic responsibility over the goods, and for installment sales, the buyer has the economic responsibility. Now, let's have a simple example to simplify these points. We have Has-Been company completed its inventory count and arrived at a total inventory value of $200,000. Okay. No, and he gives us some information. He said that there were goods on consignment. So goods on consignment for Falls company costing $50,000 were included in the inventory. And purchased goods of $10,000 were in transit, and he gave me the term. It was FOB shipping, and it were not included in the count. So here we want to determine the correct cost of ending inventory, which inventory must be included and excluded. Now, for consignment goods, here Falls company is the consigner, and our company Has-Been is the consignee. So even I am, as a Has-Been company, the holder of these goods, but the ownership of those goods are for Falls company. So it must be excluded from our count. So here we will subtract the $15,000. Okay. Now for FOB shipping, as I told you here, that FOB shipping, the ownership is to the buyer. So I must include them in my count. So it will be added. Here I will say plus $10,000. So the right or the correct inventory will be $195,000. Okay, hope that this example is clear for you. Now, this is the first issue. We determine the physical goods and which goods we must include in our count and which ones we have to exclude them. Now, let's go to the second issue. The second issue is the cost to be included. We have product cost and we have period cost. A product cost are the purchase price plus all expenses to make the inventory available for sale. For example, if the company purchase goods at blah 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 dollars, so this is the purchase price. For example, let's say I purchase the units at $1,000. So the $1,000 are the purchase price, and also I paid freight in cost. So for example, $20. And also I paid taxes like customs duties at, for example, $100. And I paid insurance over purchases, let's say also $100, for example. So the total cost of inventory will be 1,000 plus 20 plus 100 plus 100, and it will equals $1,220. So those costs are called product cost, and they are included in inventory cost. But on the other hand, for periodic costs, what about selling expenses and administrative expenses like payroll, salaries, rent, depreciation, advertising? All of these expenses are considered periodic cost and they are not included in our inventory cost. Okay, so product cost will be included and period cost will be not included, and it will appear in income statement under operation expenses. Now, the most important is the third topic, which is about the cost flow assumption, the methods of valuing inventory, the specific identification, the average cost, and FIFO and retail. But here in our topic today, we are going to talk about FIFO, specific identification, FIFO, weighted average, and finally LIFO. Okay, so let's go on. Okay. Now, sorry, okay. Before going to the methods, we have the effect of inventory errors. Now, errors in inventory. Why do we talk about inventory errors here in this slide especially? And it's connected, notice here that it's connected with physical goods quantity. Now, if the company, when making the physical count, include or exclude some goods that must not be entered in the inventory units, so this will lead us to error in the quantity of inventory, and any error in the quantity of inventory will lead to error in the cost of inventory. So the inventory errors have an effect on both financial statements of the balance sheet statement and also the income statement type. Okay, here, for example, let's go to the previous slide. Here, when we said that, first of all, the company have $200,000, then after including and excluding the goods, we reached to $195. So if we use the $200,000, we will lead us to an error in balance sheet and income statement. So because of that, physical goods is highly related with the inventory errors. Now, here is the example of the error. For example, he said that assume that inventory is understated. What will happen to balance sheet and what will happen to income statement? Now, let's first of all talk about the financial position or balance sheet statement. Now, let's defer retained earning to the end. Now, I will talk about the working capital, the effect on working capital and on current ratio. Now, if ending inventory was understated, the working capital will be understated. Why? Because working capital equals current assets minus current liabilities. So inventory is included in current assets. If ending inventory decreases or understated, current asset will be understated, therefore working capital will be understated too. And the current ratio also, it's calculated by dividing current assets by current liabilities. So when current assets, the numerator, decrease or understate, the ratio will decrease and understated too. So understating inventory will lead to understating the working capital and current ratio. And on the other hand, overstating inventory will lead to overstating current working capital and current ratio. Now, for cost of goods sold, there is a negative relationship between ending inventory and cost of goods sold. So when ending inventory is understated, cost of goods sold will be overstated. Now, when costs overstated, what's happened to net income? Any increase in cost will decrease the net income. So by overstating the cost of goods sold, net income will be understated. And when net income understated, of course, retained earning will be understated too, because retained earning is the net income that the company didn't distribute, but it retained it. So understanding inventory will lead to overstatement and cost of goods sold, which will be led to understatement in net income and in retained earning too. Now, we have here a very important note, which is the errors in inventory. They are called equivalent errors. What do we mean by equivalent errors? Equivalent errors means that it has a 2-year effect. For example, the error in ending inventory in the first year, if it understands net income of the first year, it will overstate the net income of the second year. So the balance of the 2 years, the mutual effect of them will be 0. So let's here have this example about the equivalent error and to understand it. Here for this company, we have the incorrect recording of inventory, and here the 2 columns of correct recording inventory for 2 years, for the year 2010 and the year 2011. Here the ending inventory was understated, and this led to understatement of net income for 2010. And then overstate it in the other year. I'm so sorry for network interruption. It's okay. Now, the most important part in our lecture are the methods of valuation. We have first method, the specific identification. This method, it tracks the actual physical flow of the goods. Now, what happened? Each item of inventory is marked, tagged, and or coded with its specific unit cost. So if this item is sold, the unit cost will be transferred to cost of goods sold. And if this item is still on hand, it will be considered as cost of ending inventory. So here we have a question. Can any company use this method, the specific identification, which depends on actual physical flow? Of course, not all businesses can use it, because some businesses have a high number of items, so it's empirical to use it in practical. Now, this method is only possible for companies that sells a limited variety of high unit cost. It must be limited units to be able to be practiced. For example, car dealers can use this method, music stores, and antique shops. Let's have a very simple example about this specific identification method. We have Southland Music Company purchases 3 television sets. Okay, let's say TV A has a $700 and TV B has a $750 cost, and TV C has an $800 cost. Now, during the year, the company sold 2 sets, which are the TV A and the TV C. And at December 31st, the TVB, which has cost $750, is still on hand. So it's so easy to determine what are the cost of goods sold and ending inventory. Those A and C, we did sell them. So they are sold. So their cost will be transferred to cost of goods sold. So cost of goods sold will equals 700 plus $800, and it will equal $1,500. But the TVB, which doesn't sell or didn't sell, and it remains on hand, so its cost $750 will be the cost of ending inventory. So this is the specific identification method. Now let's go to FIFO method. Okay, FIFO method, which is first in, first out. FIFO assumes that the earliest goods purchased are the first to be sold. Look here that we assume, we have an assumption. It doesn't necessarily parallel with the actual flow, but we assume, just an assumption. But on the other hand, the previous method of specific identification, it was actual method, but FIFO, LIFO, weighted average are assumption methods, okay? So under FIFO, we assume that the earliest goods purchased are the first to be sold. So the latest goods purchased are the units of ending inventory. Now, FIFO method parallel with the actual physical flow. Why it parallel with it? Because it's logical, more logical for the company to sell the earliest goods and to have the ending inventory from the latest, the newest, the most recent goods. So the cost of earliest goods will be the cost of earliest goods purchased are the first to be recognized as cost of goods sold. Now, what about average cost method? Under average cost method, as it's called average, so first of all, we have to compute an average cost to be adapted and to be applied to ending inventory. So first of all, we have this formula of weighted average. The formula is we have to divide the cost of goods available for sale by the total units. So we divide cost, okay, by units. The cost of available for sale and units available for sale. And we just said before that the goods available for sale contain two things, the cost of beginning inventory plus the cost of purchases. Okay, so we have the cost of them and divide by the units of goods available for sale. Then this average cost will be applied to the units on hand. Of course, these methods, we will take a practical example for them just after a while. Okay. This is the example that we will apply over the three methods, FIFO, LIFO, and weighted average. We have Colmart Corporation that has the following transaction. It has beginning inventory in March 2nd. It has purchases on March 15 and March 30. And look here, notice here that the unit cost of these units, they are rising. We begin with $4, then $4.4, then $4.75. This is the period of rising prices. And this is important because when we make the summary at the end of our class, we will make some rules about the period of rising prices. So we have to keep in mind that we are in a period of rising prices. And we make a sale of units, 4,000 units. Now, first of all, he calculate the cost of goods available for sale. There is a very important note, which is the cost of goods available for sale is the same for all methods. So for FIFO, for LIFO, for weighted average, the cost of goods available for sale is the same, $43,900. But what differ with us is the cost of ending inventory and the cost of goods sold. Okay, so those will be differ with us. Now, we said that cost of goods available for sale equals beginning inventory plus purchases. Beginning inventory is $8,000, and we have make two purchases during the month, so they are 26,400 and 9,500, so the total is $43,900. Okay. Now, we use, first of all, the FIFO method. Here, I would like to clear something which is very important. As we said in the earliest in our lecture, that so each system of them has its steps, let's say, steps of solution. Now, here we have periodic system, okay? We have periodic system. Now, for any method, FIFO, LIFO, weighted average, under periodic system, we have two steps. The first step is we have to calculate ending inventory, okay? This is the first step. And the second step will we calculate cost of goods sold according to this equation. As we have periodic system, we have or we must apply the two steps, whether FIFO, LIFO, or weighted average. We will first of all calculate the ending inventory, then calculate the cost of goods sold. Let's see here. Under FIFO, we said that, or we assume that the first goods purchased are the first to be sold. So ending inventory will be from the latest goods. So we will begin backward from the last to the begin. So we have 6,000 units on hand, okay? Those 6,000 units are from here. Let's go back to to our example. Where is it? For our example. Okay, this is our example. So we will begin to calculate the cost of ending inventory. We will begin from the last purchases. So we will take the 2,000 units, but we want 6,000 units. So will we go back to the March 15th and take 4,000 from it? So the 6,000 units will have two unit costs, the 4.75 and the 4.4. So we will multiply the 2,000 units from the latest purchases by 4.75 and the 4,000 units by $4.40. And we will get a cost of ending inventory of $27,100. This is the first step. And this is according to the assumption of FIFO. Now, the cost of goods sold, we can get it by this equation. We have the cost of goods available for sale, which we compute at the first slide of our example. And we said that this is the goods available for sale is the same for all methods, okay? And then we deduct the ending inventory that we compute here to get the cost of goods sold. Now we are under perpetual system, the same method, FIFO, but under perpetual system. So under perpetual system, the solution will depend on something we called it stock card. This is the table is called stock card. So under perpetual system, any method we use, we must make or draw this table. This table consists of the purchases, consists of the sales units, and the balance of ending inventory. So the 4,000 units, those, according to FIFO method, the first goods purchased are the first to be sold. So we will begin from the beginning, and the beginning is 2,000 units. So we took the whole 2,000 units of March 2nd, and we will take from March 15, the 2,000 units. And so here, let's have the pencil here, okay? So those 6,000 units will be divided into 2,000, sorry, okay, 2,000, we will take them as units sold, and the remaining 4,000 units will be here as a balance, okay? So the units sold, notice here with me that the cost of units sold are taken from the begin or the earliest purchases, because FIFO assumes that the first goods to be purchased are the first to be sold. So we begin from March 2nd. Now at March 30, we purchase another 2,000. So what's the ending inventory? The ending inventory, we have the 4,000 units from the previous date, and we have the 2,000 that we have purchased, and it will equal $2,700. Now notice with me, please, that whether under periodic system or perpetual system, and just under FIFO method, we have the same numbers, the same results of ending inventory and cost of goods sold. We have here $16,800 and here $27,100, and both of them are the same as the results that we got in our previous periodic system, okay? So under FIFO method, we will get all the time the same results, whether periodic or perpetual, but the method or the steps of the solution that differ with us. Now, let's go to the average cost. Also, we will have average cost under periodic and under perpetual. Okay, what did we say after before a while? We said that under periodic system, whatever was the method, we have two steps. The first, to calculate the cost of ending inventory, and then calculate the cost of goods sold. So to calculate the cost of ending inventory here, we have, because it's a weighted average method, so first of all, we have to calculate the weighted average. What's the weighted average? The weighted average is, we said its formula is we have to divide the cost available for sale that we calculated in the first slide of our example, divided by the whole units available, which are 10,000 units. And we get an average of $4.39. Now, this weighted average will be multiplied by the 6,000 units of ending inventory, and we will get a cost of ending inventory at $26,340. And the second step is applying this equation to get the cost of goods sold, the cost of goods available for sale minus ending inventory, and we will get the cost of goods sold. So this is under periodic system using weighted average method. Now let's go to weighted average, but according to perpetual system. Here under perpetual system, we called it a moving average. Why did we call it a moving average? Because we have to compute a new average unit cost each time we make a purchase. So here we have the same table or the same schedule as I told you. Whatever we are using perpetual system, we have to make such a table or such a schedule which contain purchases, sales, and balance. But here the method under moving average, where we have purchases, we have to calculate a new average. So look with me, please. Here for March 2, we have 2,000 units with $4. It's easy here. But here on March 15th, we have made a purchase. So we must make a new average, which is 4.3. How did we get the 4.3 unit cost? We divide the whole unit cost available for sale, which is 8,000 plus 26,400. And we divide it by the whole units, which are the 8,000 units, those. So by dividing the total cost by the total units, we get the 4.3. Now, when we make a sale on March 19, we use this average that we just calculated, okay? And the remaining units of the 8,000 units, which are the 4,000 units, are also we use also the 4.3 average. Now, notice with me at March 30, we have another purchase, which means that we have to calculate another weighted average, which is we have a balance of $1,700 and the new purchase $9,005. So we'll add them together and divide by the total units 4,000 and 2,000, and we will get the new average, which is 4.45. So under perpetual system, we called it a moving average. Why moving average? Because at each time we make a purchase, we have to calculate a new average. But on periodic system, we just calculate one average for the period. Now, okay, now the LIFO assumption, of course, as we know, under IFRS, the International Financial Reporting Standards, LIFO is not permitted to be used. But because LIFO is permitted in US and is permitted for tax purposes for some countries, so it's good to have a look about LIFO method. We just have a few minutes to end the lecture, okay? We are in the latest slides. Now, according to LIFO method is contrast to FIFO. As we said in FIFO, the first units to be purchased are the first to be sold. But here on LIFO is the contrast. The last units purchased are the first to be sold. And this is seldom coincides with the actual physical flow, but it can be good with some businesses, like for example grocery. At grocery stores we sell the latest purchases because customers want to purchase the newest and the most recent purchases. So it's good with some businesses, not all of them. So the cost of latest goods purchased are the first to be recognized as cost of goods sold, and the beginning purchases will be the cost of ending inventory. Now, this is the same example that we applied on FIFO and weighted average, and the same slide that we calculate the goods available for sale, and we got the same 43,900. As I told you, it doesn't differ according to the three methods. Now we want to apply it on LIFO. Now, under LIFO method, we said that the last units purchased are the first to be sold. So when we calculate the ending inventory, we will begin from here, from the beginning units. So we have we have 6,000 units on hand. So we will begin and take the whole 2,000 units, and we will take from those 6,000, we will take the remaining 4,000 units. So it will be here. Notice here with me. Okay, just to remove. Okay. So to calculate the first step, as we said in periodic system, is to calculate ending inventory. We begin from the March 2nd because the first goods purchased are the ending inventory, and the last purchase are the cost of goods sold. So we begin from March 2nd, then we go to March 15th to get the remaining units, and we get a cost of ending inventory of $25,600. And the second step under periodic system is to calculate the cost of goods sold, which by the equation cost of goods available for sale minus or deducting ending inventory, and equals $18,300. Now, under LIFO, under perpetual system, okay. As I told you that under perpetual system, we have to make what? We have to make this table that we called it the stock record. So it contains columns of purchases, columns of sales, and the balance of ending inventory. Now, notice here with me, we have on March 2nd, a balance of beginning inventory at $8,000, okay, and March 15 we purchase another 6,000, so we have 2,000 plus 16. This is the total balance. Now at March 19th, here we have make a sale at 4,000 units. Now at 4,000 units, we assume under LIFO that the last purchases are the first to be sold. So the 4,000 we have the last purchases. What are the last purchases before March 19? It was on March 15th. So we'll take those 4,000 units from the 6,000 units here, and we will take their unit cost 4.4, and it will be equal to 17,600. And those 6,000 will remain from them 2,000. And the first 2,000 is that on March 2nd. Now, at the end of March 30, we have another purchase of 2,000. So we have three unit costs at ending inventory. We have the 2,000, the first one. We have the remaining of those 6,000, those 2,000, and the last purchase is the 2,000 units. And we will get a cost of goods of ending inventory, sorry, at $26,300. Notice here that under LIFO method, periodic and perpetual are not the same as FIFO, okay? Now we want to end our lecture by have a summary analysis about those methods to end our lecture, inshallah. Okay, here, okay. Here is the summary of our inventory valuation methods. To sum up, my dear students, the differences between the methods under perpetual and under periodic system, as we said, under periodic system, we have to make the two steps, whether it's FIFO, weighted average, or LIFO, we have to make the two steps. First of all, to calculate the cost of ending inventory according to each assumption of those three methods. Then after that, use the equation to calculate cost of goods sold. But under perpetual system, under the three methods, FIFO, moving average, and LIFO, we have to make that schedule or that table that we used just a few minutes before. Now, as I told you that this example was a period of rising prices, okay? It was 4.4, then 4.75. So it's a period of rising prices. Now here we have a rule which says that under periods of rising prices, FIFO always produces us the higher net income. Now, look at FIFO at periodic system. Of course, this is under periodic or under perpetual system. Under both systems, FIFO will give us a higher net income as we have a rising prices period. Now look at cost of goods sold under FIFO here. It's 16th, here 17th, and here 18th. So it's the lowest cost of goods sold. And we said when costs decrease, what happened to net income? It will increase. So that FIFO, because it gives us the lowest cost of goods sold, so it gives us the highest net income. And LIFO will be the adverse of it. It will give us the lowest net income. Some companies will benefited from the lowest net income by having lowest taxes. So under a period of rising prices, LIFO will give us the lowest taxes liability. And we can notice here that in all cases, the weighted average gives us a middle number. Always it's between FIFO and LIFO. So whatever cost method a company chooses, it must be used consistently. For example, if I am as a company, choose to use FIFO method, so I must use it consistently from one period to period. Why? Because it's important to make my financial statements able to be compared and to be compared over the successive time periods. It's not logical to use the first year FIFO, then change to LIFO, then change to weighted average, for example. No, we have to use one method of them and to be applied consistently from one period to another to make it more comparable. Here, I thank you for your kind listening, and I'm waiting for your thorough discussion. Hope that everything was going smoothly and my explaining was clear and simple for you. And I'm very pleased to give you that lecture and hope to see you in other lectures, inshallah. Thank you very much.
Okay, thanks to very clear explanation, Miss. Okay, for everyone who want to ask, please raise your hand. Okay, excuse me, Miss. Do you want to collect the question or directly answer the question one by one?
Sorry?
Do you want to collect the question or directly answer the question one by one?
Okay. I'd like to have them collectively and answer at the end for all their discussion. Okay?
Okay, okay.
It's better. Okay.
So someone has a question. Rahmi Nur Aziza, you may open your mic.
I have a question, and the question is, why an outflow of cash has a negative or unfavorable effect on the company's cash balance?
Okay, is it clear, Miss?
No, there was a problem in her sound. Could you please, anyone ask, write his question on the here?
Okay, Rahmi, you can type your question on room chat.
All right.
On the room chat, yes.
Okay, maybe we can move to the next question.
Okay.
Kansa Adira Paradis, you may open your mic.
Okay, thank you. So I have a question about the inventory valuation methods. What factors should be considered when choosing the most appropriate method for a company or a business?
Maybe you can type your question so it's more clear.
It's clear, yes.
Okay. Okay, we will move to the next question. To Susila Triwulandari, please, you may open your mic.
Thank you. My question is, what will happen if inventory is not valued at the lower cost and net realizable value?
Okay.
Okay.
Any other questions?
Okay, maybe there's no more questions.
But the first, okay, she wrote it, why an outflow of cash has a negative or unfavorable effect on the cash balance. Okay. Okay, just a few minutes, please. Okay, any other questions, or I can answer the questions?
Okay, you can answer the question, Miss.
Okay, thank you for your thorough discussion. First of all, the last question of the lower of cost or market. Really, this topic is under chapter 9, not under chapter 8. Chapter 8 is talking about valuation of inventories using cost approaches, which are the specific identification, FIFO, LIFO, and weighted average. So that I didn't mention any information about the lower cost or market. This is will be explained to you in chapter 9, but to have a general look about this, after we computing the cost of inventory according to one of these methods that I just explained, we will compare it with the market. Why? Because it's not logical to record my inventory at a price I can't achieve in my market. So if the market price is lower than the cost I have on my books, so I have to decrease the inventory to the market price, and I will choose the market price to be recorded in my books. This is due to conservatism principle. Any losses I have to take into consideration. Okay, this is why I didn't talk about it, because according to the syllabus they gave to me, it was in chapter 9, but this is a brief about it. Now, for the who asked me what is the most appropriate method, we can't say that FIFO, for example, is the most appropriate for each business. No, it depends on the business. As I said that for LIFO, for example, LIFO doesn't match with the actual flow of goods, because it assumes, for example, it assumes that the last purchases are the first to be purchased, and it's illogical to have my inventory from the first purchases. It will be old. So, but for grocery stores, LIFO will give them the accurate results. So each business will choose the most favorable method for them, which give the more accurate cost for inventory and the more accurate matching costing with revenue. So it depends with business. This is the first. The second is that according to the purpose of the firm. For example, if the firm want to get high net income, because managers' incentives are linked to net income. So when income increases, their incentives will increase. And we have a period of rising prices. So they will choose FIFO method to give them net income. Type. On the other hand, if the company want to have a little tax amount, it will go to LIFO in the price, of course, in the period of rising prices, because it will give the lowest tax liability. So it depends on the type of the business. It depends on the intent and the purpose of the business he wants. And we can say that FIFO is the most appropriate, or average is the most appropriate. It depends on the business. The first question about the outflow of cash has a negative or unfavorable effect on the company's cash balance. Of course, the outflow of cash doesn't always mean that we have a negative sign. Why? Because sometimes when the company invest in long-term investments, paid cash for long-term investment or pay cash for having and acquiring long-term assets, they will gonna have an economic benefits in the future, and this will increase its income in the future. So having outflow not always is a bad sign, but sometimes this means that the company uses its cash very well and invest it in different areas, which will come back as returns and money income for in the future. Hope that I have answered all the questions. Any question?
Okay, maybe no more question. Thank you for your clear explanation, Miss. Okay.
Thank you.
Thanks to Mrs. Kiril Al-Mustadi for the attractive material. Hopefully, it can help the audience to have a better understanding of financial accounting. Now we are turning to the last agenda, which is closing. As the master of ceremony, I do apologize for any mistakes during this event. Finally, I say thank you.
Thank you so much.
Okay, before leaving this event, please everyone to turn on your camera because you want to take a picture.
Okay.
Okay, ready? 1, 2, 3. Once more. 1, 2, 3. Okay, once again. 1, 2, 3. Okay, thank you for joining this event and see you on the next event. Wassalamualaikum warahmatullahi wabarakatuh.
Assalamualaikum.
Thank you.
Thank you so much.
Thank you. Thank you.